Einen wunderschönen guten Abend, meine Damen und Herren, zu Boom und Bust der nächsten Folge. Und was bewegt uns derzeit alle? Das Thema Energiekrise, explodierende Strompreise, Gaspreise. Viele Leute fragen sich, wie sollen wir das bezahlen? Wie soll das überhaupt gehen? Die Inflation schießt nach oben, die Zinsen sind nach wie vor nahe Null. Eine Situation, die die EZB in eine verdammt schwierige Situation bringt. Wir hatten heute ja die Verbraucherpreise aus der Eurozone. Das ist schon ein heftiger Schlag ins Kontor. Wenn man zu lange wartet, hat man dann ein Riesenproblem. Und wir wollen heute über die Thematiken Energiekrise, Inflation, die Rede von Jerome Powell und Jackson Hole sprechen mit Andreas Steno Larsen. Er ist derzeit Senior Editor bei Real Vision und ehemaliger Chief Strategist bei der skandinavischen Großbank Nordea. Welcome, Andreas. I'm very glad that you're here. Hi.
Thanks for having me, Marcus.
Andreas, you are from Denmark, right? And as far as I know from your tweets, you're very astonished about the German approach to all the energy stuff. Are the Germans crazy?
Well, at least a little bit. I mean, if you look at the decisions taken over the past, say, 5 to 7 years, I don't think they have taken any good energy decisions, to be honest. I think it's very clear when you watch the price action in electricity markets, natural gas markets right now, that it was a massive mistake to just rely on Russia, even though it's been like a very official strategy for Germany over the past couple of decades, more or less. So we know by now that it was a bad strategy. We know by now that Putin basically utilized the window of opportunity when the Germans decided to take nuclear capacity out of the electricity grid during the past couple of years. And basically they still intend on doing so for the remainder of this year, which I find, a bad decision. That's just how it is. It's a bad decision.
Yeah. What about the energy prices in Denmark? Are they as high as in Germany?
More or less. I mean, at least a part of the Danish electricity grid is connected to the German grid, and as you may very well know, we are basically the land of wind turbines. So every time the wind doesn't blow, we rely on German electricity, Norwegian electricity, and to a certain extent Swedish electricity. So if the Germans are stuck in a big mess, we will also be stuck in a big mess in Denmark. That's the sad truth.
Yeah. This is the point. It's not, there's a consequence from our energy policy to the whole of Europe, right? Because it affects a lot of countries, because we have been with France the main exporter of energy. So this is a real problem which is spreading to the whole Europe. So now we have perhaps a kind of direction change regarding energy policies. Yesterday, the German economic minister said, Habeck, that it's probable that we will, prolong the nuclear atomic plants because the situation is getting out of control. So we saw the prices came down for electricity, for gas too. And that's especially because the EU was intervening, saying, okay, we cannot live with these prices, so let's do something. What do you think will happen? Will the prices go down further, or is it just a little pause within it?
First of all, I think it's important to try and disconnect natural gas prices from the electricity grid. And the way you can do that is to basically compensate gas burning plants for the price of natural gas. So the purchase price will have to be sort of covered by the government. I think that's the same case if you look across Europe. You simply need to sort of disconnect that natural gas price development from the electricity grid. That's of course a huge bill, and someone has to take that bill, no matter whether it's the government, whether it's the households, whether it's the corporates. So the bill will have to be taken somewhere in the system. But I think we're slowly but surely getting towards a scenario where the politicians will decide to take that bill, and if you compensate the gas burning power plants for the purchasing price of the natural gas, then you can actually bring electricity prices quite a bit lower, as the sort of marginal price is currently set by the natural gas price, since I'd say in between 10 and 15% of running electricity production is based on burning gas, right? So if you allow that gas price to be taken lower by subsidies, then I guess we could enter a winter with a slightly less bizarre scenario. I think that's important to sort of stress that it's a slightly less bizarre scenario. If we look at the forward pricing of electricity right now, I mean, the economy is not able to function with those prices. That's crystal clear. Right about every SME will go bankrupt at these prices, so something will have to be done.
Yeah. There's the system called merit order, which means that the most expensive power generator is setting the prices, right? Which is gas, a gas power entity. So this doesn't make sense too. And it looks like that's what the EU officials were telling within the last days. You have to change this merit order system. And your proposition would be to change that by, making subsidies for the gas stuff, right?
Yeah. I don't think it's possible to change that merit order system in any other way, because by the end of the day, who's allowed to buy the cheap power and who's not? So I think the only solution here is just to ensure that even the electricity produced via burning natural gas will be sort of in the same ballpark price-wise as the rest of the grid.
Okay. We have here in Germany the so-called Gasumlage starting 1st of October, which means that people are paying the price, right? Then the discussion started, okay, let's engage all the Germans, even those who don't have gas, which was rejected. And the question is, why don't we do the same as we did with banks in the financial crisis? When the state was guaranteeing the banks, why not, solving the problem by giving guarantees for the entities that produce gas, like Uniper, who are in really rough water? Do you think that would be a solution too, if the state guarantees everything?
I actually think that we will end with that solution. We will probably walk all the way to the cliff edge before we actually take the decision. But the issue with that solution is that it will basically just postpone the inflation problem, right? Because the only way that you can ensure that inflation naturally comes down is if you allow the demand side to sort of adjust to the lack of supply. And in this case, you basically decide not to allow the demand side to adjust for the lack of supply, because you take the bill and remove it from the demand side and put it on the balance sheet of the public sector. And I think it's debatable whether it's a smart solution on a, say, 1 to 2 year horizon, because essentially it will likely mean that we will be stuck in a big inflation mess for longer. And I'm not sure that it is a economically viable solution medium term. Short term, fair enough. Probably the only solution that works short term, but medium term we will be stuck in a big mess still.
Successful manager, smart investor, nice guy. Who do you want to be? Do you want to have the knowledge and intuition that always gives you the advantage? To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.
Perhaps you know that the German gas imports did change a lot within the last month. We now import only 9% or 9% of the gas we import here in Germany is from Russia. So it is Norway, it is Netherlands, all that stuff. But the point is that even with oil, that we have a lot of traffic going on from Russia to other European countries.
Yeah.
And Germany buys then from the other European countries effectively Russian gas or Russian oil. So this is perhaps a statistic which is not entirely the real picture. But what will happen if the oil embargo will take place? There's Germany is now, not importing Russian oil. Other EU countries do. Do you think we will survive without that Russian oil stuff?
I mean, first of all, I'm not too scared of the oil market. The oil market will always find a way because it's easy to transport. So even if Germany takes that decision, Germany will get oil via indirect channels. It's not a big issue, but it's a big issue for natural gas, since natural gas is not as easily transported as oil, right? The only way that you can transport gas without pipelines is to liquefy it. Those terminals are expensive. They take time to create. For now, the capacity is not there. So in terms of natural gas, it's much trickier to sort of circumvent all of the sanctions that's being put in place, right? So I think there's a big difference between oil and natural gas in this sense. And if we look at the natural gas situation, you're absolutely right that a part of the German import of Dutch natural gas is, by the end of the day, Russian natural gas. So the statistic is kind of flawed in that sense. But I actually think it's manageable to get through the winter with the flows that we see right now. So let's assume that Russia will continue to send in between 15 and 20% of usual flows via Nord Stream 1, via the Yamal Europe pipeline, etc. Then Germany will probably make it, but of course at a huge cost and at a huge price for the economic development. But I actually think it's likely that Germany will get to March, April without emptying the natural gas storages, since it is possible to at least partly move away from burning natural gas in the electricity grid. You can restart coal plants, etc. So it's probably a feasible scenario to limit the usage of natural gas by 10 to 15%. It's already 10% lower than last year, probably mostly due to a better weather season than last year. But if you take a few steps in the direction of energy rationing, then Germany will get through the winter, but not without a clear recession. That's kind of the base case now, right? A 10% GDP recession. I think that's likely.
Yeah, because we now pay around about 8% of the GDP for gas, and 10% roundabout for electricity, which is huge. Nearly 20% of German GDP is now for energy, right?
Yeah, and one important thing to note in that regards, if politicians decide to go ahead and sort of cover that bill, also for households and corporates directly, then we should expect basically a historical deficit on the German accounts, right? Simply due to the fact that the public sector will have to cover that bill. And as you rightly point out, it is probably a bill that in total is around roughly 20% of the German GDP by now. So if they decide to take most of that bill, well, you have a deficit of, say, 15% of GDP. Not usual numbers.
Great, Andreas. Because we had always surpluses within the last 5,000 years, right? So let's make minus 15% 1 year, perhaps or two. We can afford that, right?
Yeah, you can. But I mean, we've seen through COVID how big a difference a huge deficit from a government makes for the inflation outlook. I think the huge deficit in the US was the main reason behind the inflationary pressures that emerged in the US. I think it's much more important than monetary policy, to be honest. And
really?
Therefore, if the big deficits in Europe will sort of be prolonged from the COVID pandemic and into 2023, 2024 as a consequence of energy, then I think we're kind of stuck in a new inflation regime. I think that's safe to say.
All right, and that puts the ECB within a even trickier situation.
Yeah.
What do you think about the ECB policy? They were ignoring the problem first, then denying it, then saying it is transitory, and now looks like they're getting in panic, right? We heard Isabel Schnabel in Jackson Hole saying people losing faith in fiat currencies. Yeah. So, I mean, this is the worst case a central bank, the worst thing a central banker can say, if it's so far that a central banker warns about people losing faith in fiat currencies, it's kind of panic modus, isn't it?
Yeah. I mean, they've been wrong on everything. to be very firm here initially. If you go back to, I think it was December last year, I watched the interview with the Spanish member of the European Central Bank, and he essentially said that there was basically 0% probability of inflation overshooting target in a prolonged way in Europe. He said that, I think, less than a year ago, actually. And I mean, I remember that I tweeted, well, now you have this sort of the safest bet in place, because you could be sure now that inflation will run above target when they are so arrogant about it. But enough said about that. I mean, if you look at the situation right now, it's very tricky to play catch up with the inflation right now, since the timing of interest rate hikes right now will sort of coincide with the recession that is likely upcoming for this winter, right? So it makes it much more tricky to hike interest rates to the extent needed when you have a growth picture that is as dark as it is right now. So I'm very happy that I'm not on the board right now, because, I mean, they cannot take any good decisions by now. They should have taken better decisions 6-9 months ago. But for now, the only thing that they can do is to just emphasize the recession. And I think that's basically what Isabel Schnabel said as well. Well, no matter whether there's a recession, we will have to hike interest rates until the inflation picture is under control. So in that sense, they will basically underpin the inflation narrative, in the sense that they will hike interest rates into a recession, kill the economy. Probably not the best medicine right now, but they have to do it.
Yeah, because they waited too long and now they overshoot. They have to, because they are so far behind the curve that they have to run very fast to get in front of the curve, perhaps.
Be like me. Join XTB.
What is your opinion about the recession? When we have a recession, demand is coming down, and now inflation is caused by the unequal situation between demand and supply. So wouldn't it be wise to wait until we have the recession, demand is coming down, so inflation pressure is coming down too? Or is this not a real possibility?
The tricky part here is that what started as an inflation picture mostly from energy is now spreading across all categories as a consequence of energy prices being so high that all companies will just have to raise prices as a consequence of it. So it is not as easy to bring a broad-based inflation picture down as it is to sort of combat direct energy inflation. What is needed here is obviously a huge deflationary pressure in energy before we get back to anything that is just close to the 2% mark that they usually target, right? So to take a few anecdotal examples, if you look at the price developments in energy markets during the first couple of months of COVID, it took probably a 6% overall global drop in the demand for oil to bring oil prices to negative territory. So it is a very fine balance, this energy market. A drop in the demand of 5 to 10% makes a whole lot of a difference. For a lot of these markets. We already see it in some industrial metals that the recession is being priced in since early this summer. So I guess if we could sort of manufacture a situation where the oil demand, the natural gas demand, and ultimately the electricity demand drops by 5 to 10%, then the problem is solved. The issue here is that as soon as you allow demand to pick up again, we're back in the same supply issue, because we haven't solved the supply issue. So what I think will happen here is that we move from one extreme to the other extreme over the next couple of years. Now being the recession fear, the demand will likely drop into the winter. We will get a landslide in energy prices as soon as we allow the economy to reopen, and as soon as we allow the demand to resurface. Then we will be back at double-digit inflation because the supply side is not fixed. So we will move from one extreme to the other The extreme that we're moving towards right now is the recessionary extreme. So I actually think that energy prices will come down hard over this winter, but we will be back facing the same issues in 9 months from now.
So we have inflation in waves, right? That's what the 1970s show. You have the first wave, it's coming down because a recession is taking place, demand is coming down, but we still have the supply issue, right? But if the Russian situation is tricky too, right? You know, the Russians are burning their gas now, as we know from the border of Finland. So their infrastructure is nearly completely to 90% directed to Europe, so they cannot export their gas to China and solve their supply problem. So they have to do something too, right? What do you think will Putin do? Just continue to deliver 15-20% of the former volume to Europe, or what is he has to do something too, right? Because he's losing money all the time.
But I think it makes a whole lot of sense for him to deliver, say, 20 to 30% of the natural gas flow that he used to, since they currently have basically the pricing power of a monopoly, right? They can set the exact price that they want, and they can earn the same as sending the usual flow by just sending 20 to 30% of it if the prices remain as high as now, right? But by the end of the day, Putin is also like, I think I will call it a craftsman. So he's obviously interested in earning money. He needs money to keep the war machine alive, etc. So it will take them probably in between 3 to 4 years to really build pipelines to other regions. We know that the sanctions will limit them from actually bringing LNG terminals online in Russia. They simply don't have the supply to bring terminals online in Russia because of the sanctions. So you're right that the only feasible destination for the Russian natural gas right now is via the Nord Stream 1 pipeline, via the Yamal Europe pipeline. So it's the only way that they can actually earn money on it. So the idea that Putin will try and bring flows to zero, I give that a very, very low probability. But I think the sweet spot for him right now is to deliver, say, in between 20 and 30%, and I think he will stick to that narrative for the time being.
Yeah. What do you think about the Russian economy and the sanctions? There's a lot of criticism, about, the sanctions are hurting ourselves much more than Putin or Russia. We feel the sanctions within the energy prices very hard. But what do you think about the Russian economy? We see some categories like vehicle sales, crashing down. But now Putin is earning a lot of money with oil, with gas. So is it a real problem, the sanctions, or will it become a problem the longer the sanctions are working? What do you think about it?
I mean, from a technological perspective, the Russians will soon be very, very outdated. Obviously, they can import technology from China. So to put it in very sort of practical pictures here, they will, in 6 to 12 months' time, drive around in Ladas, calling each other on Huawei phones, right? Because that's everything that they can. And I guess ultimately that's a really bad thing for Russia, because technologically they're just decades behind us right now in the West. And that's the biggest issue for them. We can also see how the war machine is sort of outdated relative to the equipment sent by the U.S. administration to Ukraine. I mean, the only reason why the much smaller Ukrainian army can withstand the pressure from Russia is because they are technologically much more advanced, right? So if the ultimate idea for Putin is to sort of regain power in the eastern part of Europe, then this is a really bad medium-term strategy, because technologically they will be outpaced slowly but surely over the coming years.
Yeah. Do you think the war will end in winter, or is it a never-ending story?
Well, first of all, from a financial markets perspective, I think it's already a thing of the past. No one's sort of discussing the Russian-Ukrainian war anymore, since it's sort of at a standstill in the eastern parts of the country. My best guess, and it may be far-fetched, is that ultimately we will draw sort of a new border somewhere in the eastern part of the country, where the standstill sort of remains, and there will be like tanks on both sides of that new border, and then we will allow the western part of Ukraine to enter the European Union, but not NATO.
Okay, so it's kind of, unsolved solution. Russia's taken the Donbass, or most of it, which is not a satisfying solution, whether for the Ukraine nor for Russia, which is mostly a very good approach for a peace or for a stop of fighting, right? Because if one side is satisfied, it's a problem when the other side is not. So if both are not satisfied, I think it's a realistic perspective. We are talking about energy prices in Europe and inflation. We were discussing the desperate ECB policies. What about the Fed? We heard Powell in Jackson Hole, and I think you are in the camp of peak inflation in the US, not in Europe, probably, right?
Yes. Correct.
Why?
If we look at the underlying price developments over the past couple of months in the US, I think it's fairly clear that on most core measures, the price action has started to wane a little bit in the US. We can see it from the core PCE prices, so essentially the ultimate target variable for the Federal Reserve. I know that they've been all over the place in terms of which kind of inflation to target and all that stuff over the past couple of quarters, but by the end of the day, it is kind of written in facts, basically, or set in stone, that the PCE price index is the one to target for the Federal Reserve. And if you look at the core element of that price index, it's clearly waning right now. If you look at the most sticky components of US inflation related to housing costs, then it is fairly predictable that they will also come down in 12 to 18 months from now, since they lack the actual developments in the private housing market. So the reason why the housing component still sort of accelerates and still keeps the US inflation pressure relatively high is that it is a price that is observed via a survey. So you basically call roughly 1/6 of the survey group every month and ask them whether they will take a higher price if they were to lend out their home. So only 1/6 of the survey group will be surveyed every month, which means that it will take some time before you basically survey everyone, right? And that is the reason why we see housing inflation showing up in the CPI figures right now, even though the actual housing inflation happened last year. So on that front as well, it's already crystal clear that the housing inflation will slow, but it will just take time due to the way that it's surveyed.
So the data is effectively delayed, one could say, because all the sticky components within the inflation. But this means that within the next month, we will have the sticky components trending still higher. It is, one could argue that the Fed knows that, right? And we had now the July data, which was CPI and PCE both coming down, both under the expectations. But even after that, Powell was doing a speech in Jackson Hole, which was kind of a Volcker moment, a Paul Volcker moment, I think. He was mentioning Paul Volcker 3 times in his speech, and saying the lesson from Paul Volcker is that you have to bring down inflation expectations, because this is the main driver of inflation. So we have to keep the rates high for a couple of time, even if inflation comes down. So what do you think about, is he right by acting now as Paul Volcker did?
Yeah, I think it's a good idea. If you look at inflation expectations, they're clearly too high. I wouldn't say that like double-digit inflation is embedded in expectations by now, but they're clearly too high. So they need to act still, and they will act for the remainder of this year probably. The issue with high inflation expectations is obviously that it forms sort of the foundation for a wage-to-price spiral. And if you watch the wage developments in the US right now, they are basically spiraling out of control. And I think that's the biggest issue for the Fed, that the wage growth is now running at in between 5 and 6%. a bit dependent on which sector you look at. But I mean, it's levels that we haven't seen in decades, and of course, workers will ask for a higher pay when inflation is running as hot as currently. It's kind of natural. To me, it's natural, given that the contract that you've made as a society with the central bank is that if you manage to keep inflation low, we will not come up with huge wage demands, right? But as soon as they break that part of the contract, the central bank, that allows inflation to run hot, then of course the workers will also break their part of the contract and ask for more. So therefore, the only solution for the Fed is to bring inflation back to target. It's the same here in Europe. And we know that central banks, they have a sort of a very linear focus on inflation, as long as inflation is plus minus 0.5% around the target, because then they can sort of act in a very linear way. But as soon as inflation is running extremely hot, then they will have to act in a convex way. So they will have to increase the pace of interest rate hikes and also increase the severity of interest rate hikes. We see that in the European Central Bank as well now, to bring down inflation, because it's the only way that you forcefully get ahead of the curve.
So that's why they did huge rate hikes by 75 basis points, which perhaps will the ECB do too next week.
I think so.
Yeah, they have to. I think they are, hunted by the Fed. They are, they had more success in rating hikes. And starting in March, that's a huge difference. In March, ECB members were still thinking, okay, inflation is transitory. Powell did the U-turn in November, and I think it was Joe Biden to tell him, guy, we have an inflation problem, and bring us the inflation down. And this was something, quite remarkable. Powell always said transitory, inflation is transitory. And in November, with his new nomination, even with Lyle Brainard, then the statement for his new nomination was inflation is a huge problem, we have to bring it down, right? And this is shortly after Biden was meeting Jerome Powell. So I think there's a clear connection between, it's a political issue, and Powell is doing a political job because there's no alternative. And we can see gasoline prices are falling, but the question is whether inflation is coming down rapidly. That's what the stock markets hoped. They said, okay, we're just at the start of an easing cycle, which was the base of the rally we have seen since June. And now the Volcker moment in Jackson Hole. What do you think about inflation coming down slowly, or is it going faster? What is your opinion about the inflation in 23, the development?
I think it will come down fast in the U.S. Since they don't have a biggest supply side issue as we have here in Europe. I'm much more in doubt about the European inflation outlook, to be honest. So again, if we take a step back and look at what's needed to bring inflation down, obviously a demand destruction is needed. And I think demand destruction will happen just as a consequence of very big drop in real wages, just basically no matter where you look globally. That's one part of the demand destruction. The other part of the demand destruction is to basically ensure that a lot of the household wealth is spent on interest rates, right? That's a very swift way of bringing down demand, because if you raise interest rates, and if you remove the Federal Reserve from the mortgage-backed securities market, then you have a very direct channel to the purse of households, and by the way, also the purse of corporates. And I mean, watch the developments in mortgage rates in the U.S. It's also the same here in Europe to a certain extent. When they five-double or whatever it is in a matter of quarters, it obviously matters for demand. So I think we have a demand side that will be weak as beep next year as a consequence of everything that we see right now, but it's the right thing to do.
An den Finanzmärkten bietet jeder Augenblick eine Möglichkeit. Bleiben Sie auf dem Laufenden. Analysieren Sie die Situation. Wählen Sie Ihre Strategie. und handeln Sie, egal wo Sie sind, so wie Sie möchten. Mit vollem Zugriff auf alle relevanten Daten und den wichtigsten Trading-Tools. Alles, was wir tun, ist darauf ausgerichtet, Sie zu unterstützen. XTB, Zeit zu handeln.
Do you think the US economy can withstand a interest rate of around about 4% or 3.75? I mean, we have 91 trillion debt in the US economy, households, the state, the enterprises. I mean, is the crash coming because of, a such heavy debt-loaded economy cannot live with high rates? Is there a crash coming in the housing market, or is it just moderating a little bit everything?
I think the U.S. housing market will drop between 10 and 15%, given the forward-looking indicators I watch. So that's almost as bad as 2008. Not as bad, but almost. I think that's more or less a given what we've seen in mortgage rates so far this year. But I think the important equation when it comes to debt sustainability is whether interest rates are higher or lower than the running inflation rate. As long as inflation is running at 10%, then then the economy can probably cope with pretty high nominal interest rates, since the debt is inflated away by the inflation channel, right? So the question here is whether the Federal Reserve will act swiftly enough when/if inflation comes down. And usually, if you look at the past 10 hiking cycles from the Federal Reserve, they continue to hike until the federal funds rate is above the PCE price measure. That's sort of where things break, because then you have entered a positive territory for inflation-adjusted interest rates, and that's what really hurts. And we're slowly but surely getting there. They've been too slow this time to get there. But when they get there, obviously everything will break. That's what we see every time, because with the amount of debt that we see in the US, but also here in Europe, we cannot sustain positive real interest rates for long. I think that's
so. They will pivot at one point, say, okay, like Paul did in December 18 to 18, January 19, he said, okay, forget all about I was telling you 2 weeks before. So where's the point where the Fed pivots, where they say, okay, the pain is huge, we have to do something?
I don't think you should watch the stock market, actually. I rather think that you should watch the spread between the Fed funds rate and the running rate of the PCE price index. If that spread turns positive and they get compelling evidence that the PCE price index is not moving higher a couple of months, then it's a feasible scenario to expect a pivot. They couldn't care less about your housing wealth or your equity wealth or whatever right now. It doesn't matter to them. All that matters is bringing inflation down, because of the sort of negative spirals that will arise from not bringing inflation down. And as you rightfully mentioned, if you want to keep your job as a central bank chairman right now, you better bring inflation down, because otherwise you will be laid off. I could even imagine Turkish standard layoffs if they don't really forcefully try to bring inflation down, because it's everything that matters to politicians right now. It also matters more to Biden whether inflation is at 10% or 5% than whether S&P 500 is trading above 4,000 or not. I don't think Biden cares about that either.
So there's no Fed put for the stock markets. What is your prediction? Did we see the bottom in the stock market? S&P was coming down. Now then we saw the rally. Then we had the speech in Jackson Hole from Jerome Powell. Is that a game changer, or is it just a pause in the bottoming process because the markets are now, it's priced in? What is your opinion?
A lot of negativity is obviously priced in. I don't think we've seen as negative a sentiment and as negative a positioning among big institutions than right now. we we can basically watch the positioning data over the past couple of decades, and we can't find any sort of more negative data prints than right now. I think it's fair to be negative right now. Let me just say that as well. But the question is just whether there's a big drop left in equities when everybody's already positioned for it. Because we need someone to sell to bring prices even lower, right? So I'm not in the camp of expecting a huge sell-off into the winter. And I've actually started to load up a little bit in spread trades on what I will call slightly positive trades. So I've entered a long position in the S&P 500 versus a short in the German DAX. That's one way of expressing, at least a slightly positive scenario for the US economy relative to the European economy. But I'm not running like huge outright bets on equities going higher. But I'm not in the camp of doom and gloom in the sense that I don't think equities will drop like a stone during this winter because the positioning is already too negative for that to happen.
Okay, but we saw the equity allocation is still quite high. Even if sentiment indicators are bearish, we see that ETF flows have been huge within the last weeks. We saw the meme stocks exploding once again, all that stuff, we thought it's over, kind of 2021 scheme. So there's a lot of, we say, okay, many investors are under positioned, but there's a lot of positioning still going on, or they are still long positioned from a couple of years ago. So there could be a lot of pain if something happens, especially perhaps the earnings season. Morgan Stanley says, first half year for the stock markets was anxiety about the Fed. The second half of the year will be about the earnings recession we might see. Is that a point where when the economy in Europe is falling like a stone, American companies will feel that, right? And the Chinese economy with problems. So the earnings situation will deteriorate for the American companies, and the estimates are still very, very high. So this perhaps a recession has to be priced in the stock market in the US too, which is not the case. Perhaps they expect a mild recession, a little one, but nothing deep, right? So that could be a black swan moment if there's, because of the developments in Europe and China, a deeper recession within the US.
Yeah, and I think you're right that the base case for the market is a mild recession, not a very, very severe one. And obviously, if we get a very severe recession in the U.S., there will be some downside in equities. But I'm not a big fan of using earnings expectations as sort of a gauge on whether to go long or short equities, because earnings expectations are permanently too positive. Every equity sector analyst I've spoken to over time is too optimistic. That happens every single year, and we debate it every single year, and it doesn't matter a whole lot to price action if you ask me. The reason is that if you look at the importance of the first year and maybe the second year of cash flows in a discounted cash flow model, it doesn't really matter whether there's a downside surprise in year one if you keep your year 5, year 6, year 10 expectations intact. So we need a more prolonged negative scenario than just a negative surprise to earnings this year for me to really turn negative on equities, because the short term doesn't really matter when it comes to the earnings outlook. The short term matters a lot more when you look at the discounting factor. So the interest rate is important. If the interest rate goes bananas again, and now I'm talking about longer interest rates, so 10-year, 30-year interest rates, then sell everything you own in equity space. But it's the interest rate you need to watch, not the earnings, if you ask me. Okay.
Last question, Andreas, about the euro. How do you think will the exchange rate euro-dollar develop regarding the situation that we have a much severe inflation problem, energy problem? If we have the recession and then open up the economy, when the economy gets more steam, inflation is coming back, so we have another situation. What does that mean for the euro?
I'm actually a bit surprised that open positioning when you see the CFTC futures in euro versus the dollar. That the open positioning is not more bearish on the euro. It's like minus 10% of open interest. It's not that bad. It was worse in 2011, for example, during the sovereign debt crisis in Europe. So given that, I wouldn't rule out that we have more downside in place for euro dollar. I'm a very happy man these days. I make most of my money in US dollars, and I live here in Europe, so a perfect hedge for me. I've had most of my wealth parked in dollar cash for most of the year. I still think that's a good idea to at least have a part of your portfolio placed in dollar cash if possible. So, I mean, right now it's just tricky to see the upside for the euro. It may arise if we get better news on the supply front, but we don't have them right now, right?
Yeah. Andreas, thank you so much for joining the interview. It was a great pleasure to talk to you. Thank you very much, and all the best to you.
Thank you for having me, Markus.
When you trade stocks, be like me. Trade with XTB.